Hi everyone. Fubo TV reported earnings, fourth quarter earnings just a couple of days ago. The stock fell nearly 20% because of those results. What I'm going to do in this video is review the big picture results from the earnings release and also highlight if the decrease in the stock price makes Fubo TV stock a buy right now. So let's get right into it. So revenue increased by 38% to 319.3 million. The net loss was flat at 96 million in the fourth quarter. So year over year the loss stayed the same at 96 million. Year over year, this is interesting. So this is what I found really interesting, and this is the reason why I and other investors have been negative on Fubo TV stock is because of this fact here. So let's pay extra attention to this point here. Year over year, revenue increased by $80 million. Okay, so uh, the same quarter here in Q4 versus the same quarter in Q4 last year, revenue was 80 million higher. Okay? But at the same time, subscriber related expenses increased by 81 million. Okay? So revenue increased by 80 million, but subscriber related expenses increased by 81 million. In other words, it costs Fubo TV more to generate that increase in revenue. And this is what's been plaguing the business and this is what has investors questioning whether the company has a sustainable business model, because it's losing all this money on the bottom line. Yes, it's growing nicely. Look at that, 38% top line growth. That's really good growth. But at the same time, that growth is not leading to an improvement in terms of its subscriber related expenses, in terms of its losses on the bottom line. The company still, I mean, the net margin, the net loss margin decreased, but that was more, some of that was due to some debt payoff and some items below the operating income line, and operating losses worsened in the quarter. And so it seems like Fubo TV is paying is pulling together all this, aggregating all this content and bringing it over to its customers, right? So Fubo TV is going over here and aggregating all this content from sports providers, from regional sports networks, from sports leagues and all that. It's aggregating all of this, and it's paying a certain price to bring together all of this content and bring it to its viewers, right? But then it's charging its viewers less than what it's going over here and paying for the content. And the way it's structuring these deals, it seems like that with more subscribers, they're having to pay more content fees, right? So the contracts with the content providers seem to be related to how much subscribers the company has. So it's like, if you add 10 subscribers, then this is how much you pay us. And if you lose 10 subscribers, then you won't have to pay us as much. So that decreases the risk for Fubo TV. So should they lose subscribers, their content costs would decrease, but it also decreases its profit margin expansion with the increase in revenue, right? So when it adds subscribers, you're not seeing a demonstrated increase in terms of its scale here, right? 80 million increase in revenue, 81 million increase in cost. So if Fubo TV is losing all this money, then how is it still in business? Well, it's getting money from investors, right? That's where all these dollars are coming from that the company is losing on the bottom line. Those dollars have come from investors. Investors have given Fubo TV money, and Fubo TV has proceeded to lose millions and hundreds of millions of those dollars growing this business, right? So year over year, the share count increased from 148 million to 200 million. So Fubo TV added 52 million shares outstanding. So a nearly 33% increase in share count year over year. So if or when they eventually become profitable, those profits are going to be split by more shareholders. So if you were in Fubo TV earlier on, hoping that when they achieve profitability, you were going to get a big chunk of profits. That share of profits is getting diluted and diluted and diluted and diluted more and more and more as the company continues growing at this pace, at this rate, right? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So it ended the fourth quarter with 1.445 million subscribers in North America. This was up 29% year over year. Again, growth is not an issue for this company. Growth, they're growing, right? They're growing. That's not a problem. The rest of world subscribers increased by 117% to 420 million. The average revenue per user in North America increased by 4% to $75.20. Total revenue in the rest of world segment increased from 1.5 million to 7.2 million. So the rest of world segment is growing nicely, but it's still a small fraction of the overall business. You see 7.2 million compared to the 319 million overall. It's a small fraction of the business for now. The company's forecasting Q1 subscribers of 1.15 million and end of year subscribers of 1.52 million in North America. So look at this. It ended Q4 with 1.445 million and it's forecasting Q1 subs of 1.15. So it's forecasting that it's going to lose 300,000 subscribers in the first quarter. Now, it usually has a slight decrease in the first quarter because the lack of sports in its first quarter. But this is a bigger than usual decrease in the number of subscribers, and I think it's attributable to this fact here. Since the end of the fourth quarter, the company has enacted a $5 per month increase in its subscription plan. So I've been calling for Fubo TV to do one of two things: either increase its subscription plan, increase the price of the subscription, or to decrease the amount of content costs, right? Remove some of the programs to decrease some of those subscriber related expenses. And it looks like Fubo TV has done a combination of the two. It increased prices and it also noted in the shareholder letter that it's decreasing some content costs as well. So its management is working on this problem finally to try and create some difference between its revenue and the subscriber related content costs. It's now managing that. But management is also saying, like, yeah, we're doing this, but it's going to come at a cost. We're going to lose a lot of subscribers. 300,000 is what they're expecting in the first quarter. By the end of the year, they expect to recover a lot of those subscribers and end the year at 1.52 million in North America, higher than they were at in Q4 right now, but just barely. Which I don't mind. I don't mind as an investor to see Fubo TV's growth slow down, but at the same time the business be on a more sustainable footing. I don't mind that. I actually would prefer that because that will show me that this business can sustain itself without continuously diluting shareholders and going back to investors and saying, hey, look, we lost hundreds of millions of dollars. We need more money. And then coming back a year later and saying, oh, remember those $300 million you gave us? Well, we lost that. We need 300 million more. And to keep coming back to investors and saying, we need more money, we need more money, we need more money. Instead of just saying, hey, let's get this business on sustainable footing and accept the fact that growth might be slower. We might have lower subscribers to begin with, but then we can build off of that. We can grow from there, right? We can sustain ourselves. We don't need to keep going to investors and asking for money and risking diluting shareholders even more because the stock price is down more than 90% from its highs. So they keep diluting shareholders at lower and lower and lower stock prices. This isn't good news. This isn't sustainable. So I like what management has done in this quarter. The stock price fell as a result of these earnings results, and that's justifiable. It's hard to identify what price investors should pay for Fubo TV stock when you don't know what is a sustainable level of subscribers for the company? What's a sustainable level of revenue for the company? We just don't know what that's going to be once they finally price the company, price the product at a level that is sustainable. How many subscribers are they going to lose at that price, right? I don't think this $5 increase is going to do it. I think there's going to need to be more increases to close that gap from those losses. So to answer the question, is this stock price decrease a buying opportunity for Fubo TV stock? I'm going to say no, it's not a buying opportunity yet. It's a step in the right direction, but we need to see evidence of what's happening as a result of this price increase. Management is forecasting 300,000 subscriber losses. We don't know if that's a conservative estimate. We don't know if they're going to actually lose more than what they're estimating. We don't know if they're going to lose less than what they're estimating. And so we don't know how the business is fundamentally going to change in terms of revenue, expenses, and the margins on the bottom line. So we need to observe what happens so that we can determine whether or not the changes in price are having the desired effects. So hold off for now if you're interested in buying Fubo TV stock. Wait at least one more quarter. Let's see the results of these changes, and then we can make an assessment again at the end of the next quarter. As usual, I will have an update after Fubo TV releases those next quarter's figures, and I will update you on its progress. So for now, hold off. Do not buy Fubo TV stock. All right, thank you for watching this video. If you enjoyed this one, I'm going to link to a couple more videos over here and over here. So please click on those, and I'll see you over there.